Hey everyone, welcome to the Note Investor Podcast. I'm Dan Deppen, and today I'm going to be talking about borrower skin in the game. So I'm going to talk about the different kinds of skin borrowers can have in the game, and how it affects your risk level if you're originating or buying a loan. But before I get into that, just get into some, other odds and ends and things that have been going on in the world of notes as we roll into this new year here. So I've obviously been, pretty heads down with all the call the underwriter stuff that I talked about at the end of the last year. That's been really a lot of fun. If you're not familiar with that, what call the underwriter does is it helps people originating seller finance notes with the underwriting and Dodd-Frank compliance. So been having discussions and calls with just a boatload of different clients, and it's really an interesting group of folks. These are investors who are creating seller finance notes, and they do it through a variety of means. I mean, there's some people who are just going out buying properties and then, essentially flipping them. There are people with either new or existing properties that are, fixing them up and then, selling them. There are people who are converting rental properties into notes. There are people who are, note investors who are foreclosing on non-performing notes and reselling them. And it's just really interesting to see everybody's different business model and how they're going about it. And my learning curve has been super steep. So there's definitely a lot of opportunities for folks in that space. If it's something you haven't looked into, I'd kind of definitely recommend learning more about it. And it's just also interesting for me because some of the folks I talk to are very experienced and do things at a very large scale, and then there are other folks who are like brand new to it as well. So it's very interesting to learn about all the different challenges that people have. And so over the coming months, I'll be putting out a lot of content in that space to help people do those deals and get going. And then I've also been working a lot on automation for that business. As you guys who follow me, that's kind of a specialty for me. So I'm moving a lot of the processes from ones that are very manual to a little more automatic. So kind of the beginning phases of that has been building a lot of online forms that allow borrowers and lenders just to, upload their data. So we get out of this mode of borrowers having to like print out documents and fill them out by hand and then send me cell phone photos and things like that, which is just kind of obnoxious. And so I'll be doing a lot of things over the rest of the year to really streamline that process. And where that shows up for people is it's easier for borrowers. And then that becomes easier for lenders because they don't have to harass their borrowers to get stuff in and kind of handhold them as much. And kind of, I've said for a long time, like I've been kind of puzzled by how manual and old school the whole world of mortgage is, whether you're talking about banks or originations or buying and selling notes. And so look forward to continuing to make those processes a lot easier. Also done some hiring, got some help. So that's been hugely beneficial to me and has freed me up to stabilize or improve some of the other parts of the business. And I'll be doing some additional hiring as we get into the rest of the quarter. So if you happen to know any loan processors that speak Spanish, please reach out and let me know, because that's one thing I've had a lot of clients ask for is you have someone Spanish speaking who can get on the phone with their borrower. I'm also going to be doing some speaking coming up. So I'll have the Cash Flow Expo in February. I've spoken at that for the last couple of years. So that's an event put on by Fred and Tracy Rui that I definitely recommend you check out. I'll be sending out some emails on that in the coming weeks to let people know. I'm also going to be at the Noteworthy Conference speaking in Scottsdale, February 28th and March 1st. I'm excited about that. We had Ben on a while back to talk about that conference. It's one that I haven't been to yet, but I'm really looking forward to. It's a little smaller than Note Expo and DME, but I'm really excited to see what they have going on there. So I'll be there talking about seller finance. And then it's a little further out, but I'll also be holding a side session at DME, the Diversified Mortgage Expo in Nashville, around the beginning of May. So I'll send more stuff on that, on those in the coming weeks and months. And then if you're on my email list, you probably got hammered with emails towards the end of the year when I was doing a push for new students to get into the Note Launchpad online course. So one of the big changes I made in that at the end of the fall was now students have direct access to tapes. It's something I never had before. So some of these are notes that I'm selling from people in my network, and some of them are called the underwriter clients. And then I'm actually selling some of the assets in my own portfolio. And so sent out the first tape in December. And those first deals are closing or closed last week. And so the next tape is going to go out about a week or so from now. And so that's just for students of Note Launchpad. So if you're interested in getting those tapes and learning more about getting started in notes, definitely recommend checking that out. It's notelaunchpad.com. I'll put links in the description. And then I've also got the Next Note Accelerator cohort that kicked off this week as well. So bunch going on. It's really been a lot of fun. And then, on a personal note, got engaged over New Year's, which is obviously super exciting. And also had a lot of stuff going on with my kids. I'm going to be heading down to Arizona to visit my one daughter who's in college there in February. And then my other daughter who's in high school. We've got a spring break trip coming up where we're going to be going out and visiting some colleges. So lots of stuff going on, but it's all fun, and have a lot of help in these areas as well. So it's not like I'm just doing all this stuff exactly by myself. So with that, let's get into the main topic for today, which is talking about borrower skin in the game. And so, what do I mean by this? This is borrower skin in the game is basically money or equity that the borrower has tied up in the deal, and it's an incentive for them not to default, right? So when we talk about the elements of risk when looking at a loan, whether we're buying a loan or originating one, there's the borrower, there's the buyer, there's the borrower's willingness to pay, there's the borrower's ability to make payments, and then there's a collateral that's backing your asset. And we're primarily talking about the borrower's willingness to pay, right? When the borrower has skin in the game, they're less likely just to let the asset go. So for newly originated loans, this would be your down payment size, right? So how much money did the borrower put down when they purchased the property, right? So, and we look at this in terms of percentage of the sale amount. The gold standard for down payment size is 20% plus, right? That's typically what banks look for when you're originating more traditional loans. If you're creating one of these, you obviously want to try to go for 20% or as much as you can. Because once the borrower's paid that money in, they know that if they default, then they lose that. And 20% is kind of the industry benchmark where no one's going to let that go unless something's really gone wrong for them. So that's the gold standard. Now, in the seller finance world, I'm seeing a lot of these loans that are originated, actually very few are at 20%. And, part of the reason for that is a lot of your seller finance borrowers, they don't qualify for traditional bank financing. They don't necessarily have the greatest, credit and financial situation. So getting them to put 20% up is kind of a challenge. The majority of the loans I'm seeing created are in the 10% down payment range. And then I'm seeing some that are even below 5%. So from a risk perspective, if we're looking at the down payment size on a new loan, 20% plus is kind of the gold standard. If it's 15% plus, that's actually very good. In the 10% range is kind of normal, kind of average risk. And then if you're seeing things like 5% or below, that's very, I consider that very risky, right? Now, if you're the one doing the originating, it's easy to sit back and say, well, more is better, so I'll just do 20%. Now, the reality of what happens in these deals, right, is you're selling a property, and it's not like the perfect borrower is always going to just show up and appear out of the sky, right? So, you're often making judgment calls based on the price that you're selling the property for, the amount of cash that the borrower can put down, the borrower's credit and income level, right? Like you have to balance it against that. So if someone's creating a loan and, it's a 10% down payment, that's not necessarily a bad thing. That could be the best they can do in that situation. And it could be that that borrower putting 10% down has sky high credit and really good income, and it's going to be a really low risk loan to begin with. So it's not such an easy thing as just picking it, right? But those are the realities of where a lot of the borrowers fall. Now, in line with the down payment amount, this isn't really the other thing you need to consider is the purchase price of the loan, right? Was the property sold at a price that makes sense relative to the market? So it's very common in the seller finance world for sellers to kind of inflate the price of the sale. Now, to a degree, that can make sense, right? Because if for the borrower, if they don't qualify for traditional bank financing and they don't have a ton of money to put down, that can make sense for them maybe to pay a little bit more above market. Where things get wonky is sometimes people will like radically inflate the price and take advantage of the fact that some borrowers, their point of comparison is rent, and they're not even really like paying attention to what the market values are. I mean, you'll notice amongst borrowers, levels of financial literacy vary all over the flipping place, right? So if you've got a loan where, let's say, the price was sold at the market price and you've got a quality borrower and they put 10% down, that could be a pretty low risk loan. You could have another loan where the price was inflated. Like let's say the property's worth 80,000 and they sold it for 120 or 130 and the borrower put 20% down. That's great, but the borrower doesn't actually have maybe any equity in that at all because the price was inflated. And the price is inflated, there's the extra risk of if the borrower figures that out later, they've now lost a lot of their skin in the game. So down payment is super important, but we also want to look at the price that the property is selling for relative to the rest of the market. Okay. So down payment, that's kind of one form of skin in the game. The other way borrowers have skin in the game is just through equity that they develop over time, right? So some of this is as they're making payments, they're making, some of that payment goes to principal. So their principal balance is going down. And then if you look at a lot of the loans that were created, especially like 5, 10 years ago, where we've had a lot of price appreciation in the market, the value of the property has gone up a lot, right? So they have equity based on that. Like I own a lot of land contracts and things that property sold for maybe like 60, 70,000 10 years ago. And now the property's worth like 150 or 140, right? So those borrowers have boatloads of equity because one, they made 10 years of payments. So they've knocked down their principal balance, quite a bit. Maybe their loan that they started out where they owed 50,000 on, now they owe like 20 or 25. And then the property's gone up a lot as well. So that's giving those borrowers a lot of skin in the game. Now, the thing to really call out, the thing to pay attention to that may not be intuitive if you're new to this is that if you look at the skin in the game due to price appreciation or just paying down the loan over time, that's not necessarily as powerful as the skin in the game that a borrower gets from the down payment, where they're taking cash out of their wallet and handing it over, right? Because if you look at the equity in a house now to me, certainly, and probably to you, if my house goes up in value some amount, that equity to me is very real, right? Like it's almost the same as cash. It's not necessarily liquid, but that's value that I'm going to want to protect. A lot of your unsophisticated borrowers, ones that have low levels of financial literacy, they don't necessarily appreciate that. And I'll give you some examples where I've run into this. So I had a loan just recently where I was going through the foreclosure process. And one of the things I like to do when I start the foreclosure process is go get some eyes on the property and kind of do a reassessment of what's this thing worth, because Like in this case, I bought this loan 4 or 5 years in the past. So I want to check in and see what's the market value of the property, what's the condition, make sure it makes sense to start the legal process. And this was a loan where the property's worth, I'm not able to see the inside, but it's probably worth about $150,000. And the borrower only owes 60,000. And I was able to get the borrower on the phone and I said, well, do you realize that you have a lot of equity in this? And she said, no. And I pointed it out to her that she had all that equity, right? So as the borrower, if you only owe 60,000 and the property is worth 150 and you're way behind, rather than face foreclosure, it's a pretty big incentive to figure something out and keep the property. Or even if you're not going to keep the property or do that, she could sell that property and pay off the loan and just go move somewhere else. And she's going to have a boatload of cash, right? Left over after everything's paid off. That's a better alternative than writing the ship down in a foreclosure where when it sells at foreclosure auction, she still might get money back after that, but it's not going to sell as much in a foreclosure auction as it would if she were just to go and sell it herself. So did she do either of those two things? No, she went dark. And then when we got up to the foreclosure auction date, she filed bankruptcy to drag it out. So, I'll eventually foreclose on it, but it's going to take a little more time. I had another deal a couple years ago. It was a land contract. So this is one where when you go through the legal process, you don't have a foreclosure auction. You just get the property, right? And this borrower owed, I think it was in the range of like 30,000, something like that. And tried to work things out with her, could not do it. She just wouldn't do it. And then we went through the legal process and I sold that property for $60,000, right? So that was another case where the borrower could have either just squared it up and protected her equity. I mean, as the lender, I'll work out a deal if she can make payments, or she could have sold the property herself, for 60,000 or whatever, paid off the $30,000 loan, walked away with 30,000 in cash. Instead, she got zeroed on the thing. So my point is, when borrowers have skin in the game that comes from price appreciation or other things, depending on their level of financial literacy, that might impact their behavior, but it might not, right? Because it's not, for some people, if it's not cash like sitting in front of them, it just doesn't have the same meaning. So just because a borrower has equity, you can't assume that it's going to affect their willingness to repay. Now, that equity from price appreciation for you as the note holder is still extremely valuable because this is going to affect the collateral side of the equation, right? So if we take this through foreclosure or whatnot, we're going to be in a much stronger position. So it's still valuable for us from a collateral perspective. It may or may not show up as value from the willingness to pay perspective. So that's what I wanted to share with you today, some of my thoughts on that. So to kind of summarize, if you're looking at borrower skin in the game, dollars that the borrowers paid out of pocket, especially recently, is super valuable for creating skin in the game. If it's equity because of price appreciation or payments they've made over time, it might affect their ability to pay. It might not. It will still affect your collateral. So hopefully that helps you with your note investing. Let me know if you guys have questions on that and if there are other topics you want to see for in future videos. And I'll see you guys next time. Thanks.